Hello and welcome. You're watching KYC. I'm Harsh Saita. We'll quickly look at the company that we're going to talk about. That's going to be Tips Music. Why are we looking at this company? Because it's super duper interesting. It's around 8,000 crore in market cap, but it has an asset base of just 300 crore. That's one of the reasons. The other reason is it has a very high free cash flow that it distributes straight to shareholders. So again, that's the other piece that you want to keep in mind. But one, what are they changing in terms of strategy? There is going to be a large change. The number of songs that they produce annually is going to go down by 70%. Yes, you heard that right. And there is a reason for that change. Now my question is to the management is going to be as to whether that large change is actually warranted or not, and whether that rationale is punchy enough for that large change. So that's the first thing I want to know. The second one is what gives them confidence to guide for a 30% growth when the number of songs that they are producing is going to come down from 450 to nearly 125 at the very maximum. So despite that sharp fall in the number of songs that they're going to produce, what's giving them confidence to drive a 30% growth for the foreseeable future and not just for FY26? The third one is going to be the outlook on cost per song. Cost per song has gone up from 8 lakh rupees for production to 16 lakhs. And this is average cost per song. That's the math we've done basis the commentary that's come out at the end of Q4. So over the last year or so, we've seen costs rise very, very sharply. What's the outlook going forward? Given that there are these large changes when it comes to the number of songs, does the cost of song change as well? And therefore, what's the impact of that on margins? And therefore, are they confident of maintaining that 64% kind of margin number? Last couple of things that I want to know is what happens to the free cash flow that continues to come in. They've done large amounts of buyback over the last few years. Does that continue? Do they continue to distribute the cash to shareholders? And last one, what's the aspiration from a 3 to 5 year period? So it all looks good, but if you're able to justify the rationale and you're able to take care of margins, what's in it for the next 3 to 5 year period and beyond? What is it that the company is looking to achieve? This and more. But let's first, as always, dive deeper into what exactly does Tips Music do. And I'm going to quickly pull out what it does. First, it was founded in 1988. It has around 11.5 crore subscribers on YouTube. It's basically a music production and thereafter streaming company. So it produces and distributes the music that is produced by them. They are into the acquisition and exploitation of music rights. So they have already a bouquet of music songs for which they have rights. And those rights, they have a library of around 30,000 odd songs. And those rights are thereafter distributed. They also have produced and released around 40 Hindi films over the last 2 decades or so. They also sell theatrical, satellite and various other rights to distributors and broadcasters. A lot of this currently is with regard to music. It's a debt-free company. It has around 271 crore of cash and investments. This is as per their investor presentation. I want to just highlight that because cash otherwise on the balance sheet is not as large. The company earns all its revenue from license fees. Something to keep in mind. 70 to 75% of its revenue is through digital platforms. Not surprising, given YouTube, Spotify, the advent of digital is what the company has capitalized on. And the remaining 20 to 30% odd comes from other digital platforms. You have 45 to 50%, and those other digital platforms are platforms like a Zoom TV, right? So you have TV channels which broadcast music as well. So So those are also some other means in which they make money. But 45 to 50% of the digital revenue, so to kind of break this down, 70 to 75% of total revenue comes from digital. 45 to 50% of the digital revenue comes from YouTube. So you have around 35% of the top line coming straight from YouTube. The export of services is a large chunk of their revenue. The domestic, not as much, because most of these streaming services are all sitting in the US, they're platform companies. Now, in terms of digital versus non-digital, that's the breakup, 75 versus 25. So non-digital now commanding a smaller share and will continue to come down, mind you. Let's talk about partners that they have and they distribute through. And these are just illustrative because there'll be several more partners as well. You have YouTube, Meta, Spotify, and Apple Music among the plethora of other partners that they have. This is in terms of the new songs that they added every year. FY22 saw 276 songs, FY23, 896, FY24, 733. Here's where things start to change. You look at the degrowth, 18% in FY24, 40% in FY25, and a likely 70% lower from that point in FY26. So you'll want to watch out for this number as to why this is falling, and we will talk a little bit about that with the management. Let's also talk about the YouTube views which are being clocked, especially over the last few quarters. You look at the way in which the YouTube views are shaping up, and this obviously depends on number of days as well. But broadly, you have 5 crore plus views, around 6,200 crore plus views that, or 5,000 crore plus views that it clocks nearly every single quarter. And that obviously has an effect on the top line of the company. So that's how it's shaped up. Now let's quickly look at the metrics that we'll look for with regard to this one. We'll first look at the income statement. We'll thereafter look at the balance sheet, the cash flow. We'll look at shareholding. We will look at return ratios. We will look at street cred. We'll look at valuations, and we'll look at analyst recommendations. We'll look at all of these and try and assess as to whether this is a good business or not to possibly consider. Let's start off with the income statement. And if you look at the income statement, at least over the last 3 years, it's very healthy growth that you're seeing. Top line has gone up from 140 odd crore to 311 crore, which is a 32% growth. EBITDA has gone up from 86 odd crore to 210 crore, which is again a 30% growth. Margins have expanded a wee bit, which has allowed profitability to go up by 37%. It's difficult to give a business like this with a past performance, 3-year performance like this, anything but a thumbs up. So we've given it exactly that. It's as good as it can get. One thing that you should know with regard to how the numbers have shaped up, they largely spend their expenses, which is before EBITDA. All their expenses are largely on creating music, creating content. And they actually expense that out immediately. So say, for example, they are creating a song in Q4 of FY25. They will expense that entire amount in Q4 of FY25. But the revenue, largely from digital means, will come for maybe the next 1 year. Sometimes, if lucky, over the next 5 years as well. So therefore, you'll have recurring revenue over the next 5 years, but your expenses are realized upfront. And therefore, you're seeing the kind of margin number that you're seeing, because the expenses for a song which was launched 3 years ago were already booked 3 years ago. And therefore, that income continues to flow to the top line. As the income continues to flow to the top line, you have margins which are holding up very well. But you might have some expenses in a quarter or two which may be elevated because you will be producing more songs in a particular quarter than another quarter. And therefore, you might see some bit of choppiness on a sequential basis with regard to margins. But overall, when you're looking at the annual trend, you're seeing margins between that 60 to 67% kind of bracket. More so in an even tighter range between 63 and 67%. So that's something you want to keep in mind, that you don't want to look at this business from a quarterly perspective. You want to look at it from an annual perspective, whether they are able to achieve the annual numbers that they have been looking to achieve. So that's something you want to take care of. Now let's talk about the balance sheet. So income statement behind us, the balance sheet, one, its net worth is roughly 210 odd crore. Its net worth will continue to rise, but it's doing buybacks on a regular basis. It's a cash-rich company, mind you. They did mention in their PPT that they have 271 crore of cash plus investments. Now, when you're looking at cash on a standalone basis, you can see the number on your screen, around 40 odd crore of cash. They had 131 crore of cash at the end of FY24 as well, which they've used for some buyback as well in April of 2024. So something again to keep in mind is that they regularly distribute the cash that they have. They don't hold on to cash for a very long time. They hold on to cash only to produce new music over the next quarter or two. So that is something again that you want to take care of. The second thing is there's no debt on the balance sheet. It's a clean balance sheet. The asset base is extremely small. We spoke about that. It's just about a 300 crore asset base in terms of total assets. And last off, they regularly buy back shares. So your equity, your absolute equity base has continued to shrink in terms of when I'm removing reserves and surplus from that equity line, just the equity base is shrinking on a consistent basis. Over the last maybe 10 years or so, we've seen a shrink on that number. Something again to look out for, that the equity base is shrinking. So that's with regard to the balance sheet. It's a thumbs up because there's very little to nothing to complain about in terms of either debt or in terms of cash. There's sufficient of all of those factors. Let's talk last about cash flow now. Cash flows are largely in line with profitability. There was a chunky amount in FY24 which came through, due to which there was a little bit of excess cash flow which came through in FY24. FY25, that has normalized. Largely, it's a steady state in terms of the cash flow. Nothing to complain about. In terms of cash balances, they keep smaller balances. I did speak about that. Also, they have a high payout to shareholders. So they largely pay out all of their profit to shareholders. Let's now talk about return ratios. In terms of return ratios, the asset base is very small, and hence the return ratios that you are seeing on your screen extremely high. I want to also highlight that this is one of the highest return ratios that you will see. But it's that type of industry where if you're expensing out immediately and you're not capitalizing any of your costs with regard to music made, your return ratios will tend to be higher. I want to highlight FY21, the ROCE was 47%, FY22, 62%, FY23, 62%, FY24, 79%. That's how the return ratios have gone. ROE is also 48, 63 in FY22, 64 in FY23, 81 in FY24 and 86 in FY25. So you're seeing a gradual inch up with regard to ROEs as well, but expect that to happen because you've expensed out a large part of whatever you've built in terms of IP, and the unwind of that is happening in subsequent years, and therefore that explains the ROCE and ROE metrics, but it's a strong number and hence the thumbs up. Now I want to talk about shareholding for a bit. Promoter holding 62% odd, 64% odd. No concerns with regard to that, and therefore we won't delve into this too much, but a clear thumbs up with regard to promoter holding as well and shareholding as well. There's plenty of skin in the game. Let's talk now about street cred. The last 6 months, the stock has been under pressure. Year to date, the stock has been under pressure, but the 1-year returns on the counter is good at 49%, and the 5-year returns is very strong. We'll give this one a neutral. That's how we look at street cred. Now let's look at valuations. Now when you're looking at valuations, Tips Music trades at around 49 times. You have Saregama, which is the other competitor, which trades at 51 times. But you look at the 1 year forward of Tips, and this is where it starts to kind of stand out. While it's an expensive counter, 1 year forward, it's looking at 39 times. And when you're looking at maybe 2 years forward, it'll compress even further to sub 30 times because the growth clip is very fast. So valuations, there seems to be some comfort, but you want to see whether the new strategy is getting executed, because currently it's sitting at 50 times. If the new strategy does not execute well, then you might not see such a fast compression in price to earnings. And hence we've given this a neutral because there's a bit of a question mark there. The last one is with regard to analyst recommendations. There are 5 buy calls, 1 hold call. There's only 6 analysts covering this, and hence we're cautious. We've given this a neutral on that count, but the return potential is 21%. In terms of multiple, this is trading at the lowest multiple in the last 12 months, 1 year forward, that we have seen this trade at. So at 39 times, the multiple is also the lowest, and hence you are seeing that upside that we are seeing. Let's quickly though go across to Kumar Taurani, who's the managing director at Tips Music, on what the strategy is and what he is looking at in terms of market share. Welcome, Mr. Taurani. It's good speaking with you. Let me first start off with why this change in strategy? Why go from 450 odd songs to do 100 to 125? What's the thought process behind this like?
No, we won't give out market share. On the contrary, we will increase our market share. See, when we make 500-600 songs, so our time is limited. It's distributed in all the songs. We have a team of around 10 people. So if you calculate, one person is making 50 songs a year average. I'm talking just an example, a number, and 50-60 songs versus 10 songs he has to make. So I think he will be more focused and give me more quality, and we can reject more songs. And we are not compromising on the quality and on the money also. Whatever money we have planned to invest, we will invest that money. We will sign bigger artists. We will do bigger marketing. All that we will do. So that is a focus for coming years.
Got it. So that's for FY26. What about beyond FY26? Will you go for a larger base in terms of songs beyond?
Please understand that our focus is on a quality. So maybe 80 we karenge, yeah, maybe we can go up to 150 also. That's not a hard and fast rule. We have to just stick to a number. Whatever good quality songs we will get, and we have a budget, we will invest and we will acquire or produce. I think the way FY26 is behaving, I think more or less we are already there. And I think this year, okay, maybe last year some songs left out, maybe it will touch that number, but around 125, 150, yeah, this year.
And sir, the total market in terms of how India is shaping up is going to grow from around 7,000 to 10,000. So despite that, you will stand out and you will continue to do 100 to 125. So the number of songs is not going to be the focus at all.
I think we must realize what is the success number. I think if you see, our main focus is on film side. So if India produces 1,000 films, the success ratio is only 8-10%. So our focus is we should be in that space maximum. And if you see my Tips ka track record from 2005, 4, 5 onwards, 90s we were a very aggressive player. We were the 60, 65, 70% of that period's content Tips has acquired. And if you see at that time, from 88 till 2002, 3, anywhere, any award function or any award, out of 10 songs, 7, 8 songs, of top 10 songs, 7, 8 songs belong to Tips. And among the 5 nominations in many awards, we had 3, 4 nominations. So we want to, after that, when market changed to physical to non-physical, so we concentrated on maybe 30, 40 songs a year, but my success ratio is 90%. So that is the key to the music business, I feel. And touchwood, we have a very experienced team. So I think we can make it. And that is the next growth for us as well. So I think our focus is there. Plus, one more thing, nobody understands that music business repertoire catalog is very, very important. If we all combine entire industry produce good new numbers, then our new numbers business will be 20-25%. But still 75-80% will be a catalog business. Whatever your favorite songs over the years you have selected, you have separated, you have made your own playlist, you won't forget listening those. In case you like two more songs, you will add to your playlist. But you keep listening all those songs over the years you have liked. So, and whenever there's no good new releases, so there will be a 95% of a catalog business. Only 5% will be new releases. So majority is catalog, and our catalog is touchwood doing very, very, very well. If you see, there is a no major new releases we have done for last 4 or 5 years, and we are growing 30% year on year. So that is because of our old repertoire, whatever hard work we have put in last many years, that is actually giving us fruits.
Right. No, so I fully appreciate what you're saying. So, but you've also guided for a 30% growth. Give us the breakup. How much of that comes from old songs versus how much will come from new? And will that 30% growth be sustainable?
I think so far our new releases, you can say 15% contribution and 85% comes from catalog. But our going forward, our target still is a 30% top line we have to do for next 2 years, at least 3 years. So among that also, we want new releases should be more. So now target is we should achieve 20-25% to new releases and 70-75% should be a catalog.
Very interesting. Now, sir, the other piece is with regard to costs. When I'm looking at, and I've done this math, the cost per song has doubled last year versus this year for you. Where do costs go in this new shift in strategy? Where do costs go?
Cost will continue to rise. Harsh, please understand, we can acquire a song from 50,000, say, like 7-8 crores also. So that is the range. So we can't actually pinpoint. If I'm taking a big blockbuster movie of a multi-star film or something, so I have to pay 25 crores, 30 crores, 40 crores. Pata nahi abhi kya ho raha hai. But there's a very tough market. But we are not in that rat race. But there is like that.
Point taken. And sir, therefore, where should margins be at? 85% is from old catalog, 15% from new. Costs will rise. Where do margins go?
My catalog is doing really, really well. So our margin and then that entire catalog, whatever we release, whatever music we make or acquire, we release that music, we write off that content cost in that same year. So that is a big advantage Tips has. Or this is not, we are not doing from now. We are doing this since beginning. If I carry forward for 4 years or 10 years, then I have to pay more tax and it will hurt my cash flow in those days. Those days there was a very cash flow was very tight, so we have to need money quickly. So we used to write off entire content cost same year. So that is from beginning we are following. Still we are following that.
Okay, so sir, therefore EBITDA and PAT should also grow at 30%.
EBITDA will maintain. And PAT also, we are trying we should be at 30% in the 30% range, 30% top line, 30% bottom line. We should achieve PAT. That is our target for this year, next year. Yes.
What about distribution? You're a low capex kind of business, and therefore, will you continue to distribute dividend?
We give it to our we declare dividends or whatever last year we made money. Last year, our PAT was 127 crores. We given 136 crores to our investors, shareholders by way of buyback and dividends. So we keep continuing doing that. Big dividends.
Right. Sir, talk to us about what the aspiration is in the next 3 to 5 years. Your low capex intensive, your 30% growth on top line, bottom line. What's the aspiration in the next 3 to 5 years?
See, we are very focused on this business, music and films. We have both two separate companies, films companies separate, music companies separate. and we are very focused and we are really doing good. I feel we can really do good in film business as well. It will take little time, but I think our focus is to build these two businesses properly and keep growing. And if we don't want to do anything other than this, so very focused, we'll continue doing this.
Okay, and so what's the risk like therefore? It looks like a very low risk business, 85% of top line largely guaranteed. Is the distribution model a risk?
I don't feel there is any risk there because they also need a business. They are also having they are not paying us any, earlier they used to pay us upfront, a minimum guarantees, but now they are paying us from earnings. So they also making money from us and they are getting content, you can say directly free, actually. Okay, they are sharing some money with us and on a streaming basis or a advertising or a subscription basis. But we are investing so heavily, so they understand that. So I don't feel anything about that. And this is happening for last so many years. And if you think this is the same practice they are doing internationally. So why you want to disturb a smooth business is going on? Nobody disturbs that, I feel.
Okay. Thank you so much, sir, for coming in and breaking this down for us. Very interesting, and wishing you all the very best for the next year or so on this new strategy and its implementation. But what we're going to do is we're going to quickly also look at the ratings that we've given, the KYC rating on this one. Such strong growth, definitely a thumbs up. Balance sheet, thumbs up. Cash flow, thumbs up. Return ratios, we've seen how return ratios have gone up because the asset base is so low. Shareholding is a thumbs up, 65% owned by the promoters. Street cred, there's been some bit of a hiccup with regard to returns over the last 6 months or so, but the last 12 months have been solid. Valuations, again, not looking cheap by any stretch. It's at 50 times. That's what its peer also trades at. But there's going to be a new strategy at play. Whether that valuation holds fair or not is a neutral on that count. And analyst recommendations, just very few analysts covering this one. So we've given this a 6.5 on 8 on KYC, at least for the moment. So that's our KYC rating. With that, it's out of time on this edition of KYC. We hope you found this helpful. Very interesting business. At least that's how I found it. Stay tuned. More action on the other side.